This is your Lead Left podcast for the week of September 9th. I'm Randy Schwimmer. Welcome back. This week's commentary, Heads and Tails, was inspired by the discovery of a two-headed snake in the Pine Barrens of New Jersey. We're not sure if this is a good omen or a bad one, but there's evidence of both in the credit markets today. Public markets remain buoyed by the prospect of trade talks with China, as evidenced by near record highs on the major equity indices. On the other hand, generally lower interest rates seem to signal both another Fed rate cut and an economic slowdown could be around the corner. Like our New Jersey snake, nicknamed Double Dave, investors are of two minds. Stick with the search for yield, even if that brings greater risk, or go to cash and wait until things become a bit clearer. A source told Refinitiv LPC, quote, "We have seen more investors decline transactions perceived as over-levered or loosely structured for issuers in less predictable sectors of the economy," unquote. We note default rates continue to improve, 1.29% for August, down from 1.32% in July per LCD. But the more forward-looking share of distressed, broadly syndicated loans rose to 4% last month from about 2.8%, the highest level since 2016. With broadly syndicated loan demand constrained and the forward calendar building, will that create a floor on yields? And will the middle market follow suit? Read this week's commentary to find out more. Our chart of the week looks at LPC's loan and high-yield bond fund flows. As the Fed reversed course on interest rates last year, cash left loan funds and piled into high-yield bond accounts. So far this year, $26 billion of cash has exited loan funds and $11 billion flowed into bond funds. Last week, we asked readers, did you meet your investing budget for the second quarter? Over half of respondents said they fell short of their budgets. That share reaches a record high versus last year's results. This week's question is, what's the greatest risk to loan market sentiment for the rest of 2019? In our Content Partners segment, we feature DebtWire's chart on high yield versus middle market debt held by BDCs. The yield premium for middle market loans over traditional high yield stands at 467 basis points. That's the highest level in 5 years. This is Randy Schwimmer for the Lead Left. Thanks for watching. Have a great week.